How are we doing anyway, guys? Hope you're doing well. As is always the process, we are going to go through the market report, complete breakdown of the report, dig into what we're looking at this week in the macro scene, and then following that, for the training room members, we are going to dig into the US Open this afternoon to get ourselves primed and ready for the US Open in the hopes that we're going to see a decent kickoff to this trading week. So, first of all, market analysis and economic impact report. Let's get stuck into it, team. So last week actually turned out to be exceptional, I would say, given the macro scene that we were actually trading in last week. I'm actually completely stoked on the fact that we managed to bring in the 3.56% that we did. I would also say that I was completely stunned at our performance in last week's non-farm payroll. Now, utilizing the data that we had from last week's market report on the Monday, we did have a little inkling that this time the NFP event itself would create some type of market volatility, which it did actually end up doing this time around, which was great. I was not actually present for the NFP, as you well know. But in doing so, placed a bunch of pending orders. If I placed pending orders on every trade that we called out last week, every single one would have been a winner. Every single one. I didn't place trades on every single one, and I decided to choose 4 out of the 6 that were available, and every single one of them won. So getting back to the trading desk and having a look at the green. It was a great sight. It really was. So yeah, very, very happy with that. I know last week's NFP was a little bit more quiet. Obviously, it was on a Thursday and not the Friday due to the 4th of July US bank holiday. Yeah, really did very well. So very happy with that. Now, in terms of market exposure, last week we had a 40% or 80% split with Forex and indices, so 40 on each, with commodities wrapping up the final 20. So it was very balanced, I think, last week. In terms of our main tactical plays, we had the Dow Jones and the Euro USD, which really were the highlight trades of the last week. I think one was a 2.72 and the other 2.74, or vice versa. So that was very good as well. Looking across at the daily gains, we didn't actually have a single drawdown day last week as well. Monday at 0.1% essentially, Tuesday just over 0.6%. Wednesday at 0.5, and Thursday coming in at a whopping 1.4. I think it was actually a 1.38 or something, just shy of the 1.4 mark. So it was very, very, very good. And yeah, like I can't say it enough. Really happy with that. That obviously it was the end of Q2, beginning of Q3 as well. So I mean, you know, cyclically speaking, it's usually a pretty crap time to trade, frankly, at the beginning of a quarter and the end of another quarter. It's usually a terrible time to trade, but last week really didn't show that in its in all of its glory. So there you go. In terms of the portfolio metrics and what we are looking at across the year so far, we have a yearly percentage gain so far. Net result at 82.6%. Great. A total overall 2.8% risk-reward ratio over the total account. And again, great. 0% risk of ruin continues to be the theme, which is fantastic. You don't even want to see that at a 0.1%. Monthly broken down is 12.7% on average, with an average weekly gain at 2.9%. So very, very healthy, strong metrics so far in the portfolio. In terms of trading volume, obviously we got July off with a little start here. We didn't actually take too many trades last week. Trading volume was a little bit reduced. I think we had 15 trades in total over the week, which, I don't know, some weeks we're doing upwards of 20 to 25 trades. So I think the 15 was a little bit more held back than usual. We had the S&P 500 at 1.93% total gain from open to close. UK FTSE was at plus 1.31%, so it was a bullish week in the markets. In terms of the UTCF, obviously we did beat those, which is great at the plus 3.56. Good afternoon, Corey Tim. Good to see you, mate. So moving down into the juicy stuff there, market trends and opportunities. This week I have swapped out a US trading asset for the European one, being the DAX, the German 40. Now, this week we've got some big stuff going on, guys, okay? Not necessarily due to the actual econ, and we'll come on to that in a moment. But this week we do have President Trump and the White House administration ultimately notifying the countries of their various tariff rates. Now, he has put in a pause on these until August 1st, which I've stipulated there. But they will be aware of what those tariffs are, and so therefore we all will be aware of what the tariffs are going to be by July 9th. Now, today is July 7th, so on Wednesday is going to be the day where we find out what those tariffs are. So this week is going to be a big one. It does carry an increased level of inherent risk, and we do need to be prepared for it. That being said, German 40 is my weapon of choice this week for the stock indice. Either looking for a rally up to the previous highs or a rally back down to the previous lows. That is a weekly time frame, ladies and gents, by the way. So we're not looking at that on a daily. Obviously, we're going to be day trading it and looking at intraday opportunities, but the weekly just gave you a really, really good, clear understanding of where we are going. Either the previous high or the previous low, but I am looking for a continuation of the consolidatory motion that we've been in currently with the DAX over the course of the last couple of months, long term. Now, next up, euro against the Australian dollar. Now, this week is the week for the RBA. Okay, so we do have the Reserve Bank of Australia's interest rate decision. And I think it's going to be quite the bit. I don't think it's going to be huge, but I do think it's going to be bigger than the previous couple that we have had. That being said, Euro Oz, I've got split opportunities here. Obviously, we've got the break, close, retest continuation with the trend, as you can see in front of you. But I also have the rejection trade, and that's if price action comes up to liquidity, then, of course, the RBA interest rate decision takes place. I would be leaning on the side of bullish price volatility for the Australian dollar, and so therefore we get the sell-off as a result in the Euro Oz, where that Australian dollar is powering up and the euro is declining in value against it. So that's that one. Now moving down into the weekly energy expectation and metal expectation. We're using natural gas for our energies, and we've actually got silver in for our precious metals. I swapped out gold for silver this week, and that is primarily due to the tariff side of things as well, which I've also stipulated down here, so you guys can download your report and get stuck into that whenever you wish. Natural gas this week, looking for the breakdown into liquidity. A couple of decent fundamental reasons. The first being, I am looking for the sell-off into liquidity because there is an increase in inventories. So we have more natural gas than we expected. There is that. But the demand to come back from that liquidity point also makes perfect fundamental sense because we are looking at a much, much warmer climate than we were anticipating. And that will in turn boost the cooling demand, which I've also stipulated down there beneath the chart. So there's the perfect fundamental setup that aligns with the technical setup that we're seeing in front of us, and that is our sweet spot. 50% technicals, 50% fundamentals. That's our edge, a big edge it is, a big edge that it is as well. So that's what I'm looking for in natural gas. We are looking at the breakthrough of the ascending level, as you can see down there. If that doesn't take place, then it's a buyback from that point anyway. We've got some really nice clear areas for target profits, so we should be able to turn this one into a few quid without too much of a problem. But the fundamental play is the big one, so let's stay tuned for that. Scrolling down then into the market challenges this week, like I said, it's pretty quiet in terms of the actual econ. It's a big one in terms of tariff news, so we are going to obviously got that going on in the background, and we are going to be covering that in real time as we always do. But with the econ, RBA interest rate decision in terms of the price bias to the ideas that we have in the report this week is coming in at a 7 out of 10. So it's actually quite significant. You guys might be wondering to yourselves, why 7? Why did it get rated that kind of high? Because that's a big number for an econ event in terms of how this model works. Well, actually, Australia has a big thing to do with silver, and so therefore it's not just going to be affecting the Euro Oz, but it could also significantly affect silver as well at the same time. It's not likely, but it could do, and if it does, it probably will be quite the event. So both of those are going to be directly relevant to the RBA interest rate decision. The second thing is the FOMC minutes. The FOMC minutes is actually registering at a 4 out of 10. A 4 out of 10 is not a large number, but it is registering, which means it is going to cause somewhat of volatility. Now, in terms of what we've got going on here, there's not an immediate response to the FOMC minutes, of course, but the fact that it is US and we have a euro instrument here, that could cause, obviously, some market volatility. Euro is on the other side of the dollar, the Euro USD, the most highly traded FX pair in the world, and so therefore, if you have something that affects the US dollar, naturally, cross-asset correlation is going to affect the euro. So that's there as well. Now, if we move down into the state structure volatility index, at the moment, commercial longs versus shorts, nothing at all that is a notable call out. Nothing. The only one that you might think is the DAX 40 or the German 40, 53.2%. It's on the cusp. There's nothing major to say about this one. The VIX was low. And so if there's anything to talk about here, it's the fact that the VIX was trading at around 44 point something percent last week. Don't quote me on that. Check the last market report. I can't remember off the top of my head. I believe it was around 44 point something, and now it's at 48.88%. So we're looking at a 4 to 5% increase in longs versus shorts in the VIX. There might be something in that. We may be building volatility due to the nature of the tariff situation, the geopolitical situation going on with the trade war. There might be something else going on behind the scenes that we are unaware of at the moment, which is why the VIX is powering up. We don't know just yet. We'll probably see the bleed out effect from that over the course of the next 7 to 14 days, or 5 to 10 trading days, that is. So as we go down then, economic and order book impact reports. Now, the only thing that wasn't registering above as a direct market challenge to our trade ideas is the Canadian unemployment, which is also out this week. Now, the economic impact scale this week is registering the RBA interest rate decision in terms of broad market impact at a 5 out of 10. We're looking at the FOMC minutes at a 7 out of 10 and the Canadian unemployment rate at a 4 out of 10. So CAD unemployment still registering as quite the big economic event, affecting obviously predominantly CAD pairs. So do watch out for that one. The FOMC minutes is probably going to be the highlight of the week at a 7 out of 10. Not entirely sure what we're going to be hearing in this one. Is there going to be anything about the geopolitical scene? Probably not too much. I do want to see what is going on with their monetary policy thoughts and sort of setup at the moment when they are anticipating new tariffs being imposed on nations around the world. That's going to be an important one for me. That's what I'll be kind of listening into. We all we're all aware enough about the situation with the Fed, rate cuts, revisions, September, 2 rate cuts by end of year. We kind of get that situation. At the moment, the inflation data is supporting that to a certain extent. But this trade war that's going on in Trump, in the White House administration, and their tariff plans will stir things up. And it can cause more inflation, not less. So it would be interesting to see if we do actually still see the continuation of the idea of 2 rate cuts coming into play this year, or in fact, if we don't, and we just see the one right at the end of the year before we head into 2026. I'm thinking about that at the moment, and I'm also thinking about how we can monetize those trade ideas as well. So stay tuned, obviously, for that one. As we move down then into the multi-asset impact gauge, this is for indices, equities, FX, and commodities. We've got a pretty significant impact in the Forex market this week, with only minimal impacts in the rest of the asset classes as a direct result of what the econ is telling us. So that's what the economic data is, what economic data sets are actually being released this week and what's happening. The FX market is going to be at the forefront of the brunt of those releases. Money flow trends, this is the buy side versus sell side interest per asset class, per total liquidity. So we have indices at 49.77% bought, which means there are more shorts than longs in total monetary terms in the indice markets. There is a significant increase in commodities. Currencies in the FX space, 52.13%. It's relatively balanced. But the commodities is the interesting one here, okay? Commodities at 56.46% bought, oversold. That's a big deal to me. This isn't an instantaneous thing, so you've got to think this could have impact in the markets over the course of the next 5 days. That's how it works. This is a big thing for me, looking at commodities at the moment and where they are. And we're going to come on to commodities, obviously, down the line. We'll be doing a full study on commodities tomorrow, especially. But I think where they are at the moment, we have seen weakness. We have seen money flowing out of our commodities. I think looking at an increase like that to 56.46 really does shout volumes about where we should be and where our money should be over the course of the next 2 trading weeks, which we will undoubtedly get stuck into as well in a deeper view soon enough. Then moving down into the final set here, we've got the equities in focus this week. Nvidia back up there. We've got D-Dog, MITS and IMAX all looking relatively good for a 2-week spread buy and hold. Spotlight equity of the week this week is Broadcom. Couple of my reasons down there as well. If you're happy to have a look, that's great if you're into your equities. And then institutional buying interest by sector, technology at the top, industrial, financial, and what's come up on number 4, metals. I'm making a big deal out of this at the moment because we've never seen that before. That's never registered. Okay, this is all taken from a bunch of really expensive sources compiled into blocks of information that are ultimately presented in this format to you. Metals is on the 4th top sector of interest by hedge funds and by commercial liquidity at the moment, in conjunction with the fact that we've had a whopping uptick in commodity purchases as well. So I just feel like something's going on here. The signals are there, so it's just about how to monetize this at the moment, and that's going to be where the magic happens. So stay tuned for that one. But anyway, that is the market report for this week, ladies and gents. I hope you've enjoyed it. If you haven't got your copy already, please feel free, if you're not already, to hop in the trading room and download your free copy. It is entirely free for all of our members, so you can feel free to hop on in and download it from the My Report channel inside the trading room. And yes, if you're not a member already, of course, in the trading room, then I wish you a wonderful trading day and week ahead if you're not around. And I look forward to catching up with you in the next market report vid. So I'll catch you then.